Hey guys, this is Sia, and today what I want to do with you guys is really explain or basically just go through the importance of backtesting, the factors that you need to look into when you're backtesting. And I'm gonna take you through as well, just showcase to you some of the trades that I backtested. Now, again, looking at those particular type of trades, so I was actually testing out one particular strategy, and the strategy involved it's a day trading strategy basically. So I was actually looking at that, and it gave me some interesting results. So I might actually go through with you some of that just to showcase to you the what type of results you can actually find, or what type of things you can actually find as well when you have data with you. So let's actually look at the first important thing when it comes to backtesting. So when you're actually backtesting a particular strategy, you gotta first understand what is your objective. So again, the first objective that we're trying to find is we want to find out whether or not that particular strategy that we are willing to actually trade and risk our money on, is it a profitable strategy. All right, that's really the first thing that we want to actually find out. The second thing as well, in terms of backtesting, is when we're actually getting to the actual backtesting itself, is we want to rely on data. So data is important. And what do I mean by data? Historical data, basically. Meaning we want to go as far as possible throughout the chart. So as I'm recording this, this is 2019. So if I am testing a particular strategy within the 60 minutes or the 1 hour time frame, I want to at least get a minimum or a sample size of trades of a minimum of 100. Okay, going as high as up as 200, 300, 400, 500 trades. Now, the bigger the sample size, the better, because now what's actually better about it is that you are now going to have a huge pool or a number of trades to actually sift through and see according to your lifestyle. Because what's important as well is once you've found that your strategy is profitable and you've gathered a big enough sample size, you're going to now see in terms of those particular trades or that system, you want to see if it's profitable within your trading time. And what I mean by trading time is, let's say you're working a 9 to 5 and you're going to be trading, let's say in your occupation, you can't really trade, let's say, from 9 o'clock to 5 o'clock. So then you're going to want to look at or evaluate trades, let's say from in the morning, from 6 o'clock all the way, maybe 6 to 7, for example, from 6 o'clock to 7 o'clock in the morning, on to see if those particular trades, if they are working out or are profitable trades. And then once you've knocked off work, maybe trades from 6 in the evening to maybe 9 at night. All right, so that's actually crucial, and that's a lot of mistake that people actually make, is when they're actually doing their back testing, they're taking all their data together, formulating and seeing whether or not their win percentage is high, their average risk, and they do the whole calculation, and then they factor in all the trades combined, which again is not really advisable. Okay. Thirdly is when you are actually in the charts. So let me go to the charts right now. So I'm going to disappear for a second, and we're going to head over to the charts, and I'm just going to showcase to you why it's important when you are doing your back testing. You always have to look from left to right, meaning that when you are doing your back testing, it's not a good idea to now cherry pick, where you have your chart in front of you, then you're saying, okay, this trade lost here, this trade won here. That really is not the way to actually backtest. Now let me just show you the method, what I'm talking about here. Okay, now as you can see, we are on the charts and we are looking at the New Zealand USD. All right, so okay, it's not actually performing as well because I had a position here, a 26.18 buying position, which again I got stopped out. So let's see. Now, if you are backtesting, let's say you are backtesting, but what strategy? Okay, let's look at the 2618 as a strategy. All right, you would then look from left again to right. Now, your starting points would be here. All right, so you can see there's these two bullish candles, right? So you want to actually do it bar by bar. Now, one, you would have identified that now you have a completed double bottom, all right? Mentally now, okay? You'd want understood, or in terms of what is a double bottom or how we identify a double bottom, because it's one of the rules of engagement for a 2618 trade is one, you need a qualifier is a double bottom. And then the next step would be we want price action to break and close above our neckline, which is at that level. Then we want a retrace to the 618 Fibonacci ratio. Okay, so now this is how you'd go about doing it, right? Okay, you do it bar by bar. All right, so we would have had our two bars, then the third bullish bar would have closed. All right, still we're still in that phase of, okay, we're now waiting for that pullback to the 618. Let's see if our next bars actually happen. Okay, we're still in consolidation. Okay, right there. So let me just zoom this closer so it would make life a little easier. Okay, there we go. Okay, all right, so we've had our bullish bars, and then the next bar would have been a bearish candle, two bearish candles. Okay, we consolidating lower. Then we would have had our bearish bar, this huge one. Then the next step would be, okay, now let's actually take our Fibonacci tools, all right, from swing low to swing high. Okay, and we want to see whether or not we come to our 618. So let's see what the next bar gives us. Okay, boom. The next bar is bullish. Okay, it wouldn't have actually entered us into the trade. And then our next bullish, and then there's a bullish candle. Then the next one. Then the next, and the next. Then the market just continued. Okay. Okay. Then we now in consolidation at this point. Okay. Let's take our Fibonacci and expand it more. Okay. All right. And then we continue consolidating. Okay. And then at this point here, okay, at this a bearish bar, it's not really a bearish engulfing bar because it doesn't really engulf the prior bar. Okay, so what it actually does is we then hit the 618 level, which means that our position would have been filled. Okay, that would have been our entry levels, entry level there. Then we would have had stops slightly above that. Okay, so let me see for stops for our bullish 2618. We'd have had stops down here. Okay, so let's see what level is this. Is 68.64. Okay, that way would our stops have been. So you then go bar by bar, identifying or not whether or not that trade would have hit targets, or would have hit our stop loss. So at this point, we would have hit our stop loss, and it would have been let's see, 7 in the morning. So 7 in the morning, we would have had our position taken out. Now, then how do you go about in this whole process doing the recording? Then what you would in essence do is you would then go onto your actual spreadsheets. Now, this is the important part, the important bits when it comes to the spreadsheet. Now, a spreadsheet is where you'd actually tabulate the whole entire trade. So, for example, in this particular spreadsheet, you'd pretty much name it backtesting 2618 60 minutes, 60 minutes. Then the currency pair you are working on, and in this instance, we would be working on the New Zealand USD. So pretty much that's the process. And then you'd fill out each and every trade. Now, pay into consideration, on this one, I was actually looking at a FTB strategy, and I was looking at it in terms of, in 2017. Okay, so I'm not really going to go into the technicalities of this particular strategy in terms of what I was actually looking for, the rules of engagement for the strategy. But I just want to, okay, let me just get back onto the screen. Okay, okay, I'll do that, but then I'll come back later because then I'll end up blocking you guys with this. Okay, so again, so when I was actually looking at this, so it's important one for you in your trade log to log all the trade setups. Okay, as you can see, I have over 100 trades logged on here. Okay, and it's within the period of 2017 for this particular strategy. So it's important for you to at least get a minimum of about 100 trades going, and then you put it onto your spreadsheet. And then it's going to show you some interesting information as well. For example, over here, okay, I took about 114 total trades. 65 of those trades were winners. 49 of those trades were losers, meaning that the win rate was actually 57% win rate, all right, on this particular strategy. And then you would see that the average winning trade was about $3.70, and the average losing trade was $2.25. Now, this would vary extremely depending on what the dollar per point is. So for this test, I was just testing in terms of if, let's say, I was trading on a $100 account, and this would have been my risk per point. So this would actually vary in terms of how big your trading account you want to actually start off with. But again, this is also adjustable. So in the spreadsheet, you can always adjust all of these figures in terms of that. Okay. As well as total P&L, $89. Average P&L per trade, you're looking at about 78 cents. So on average, basically it would mean that the average trade I would have taken would have gained about 78 pips. Basically, that's what it means in its general sense. 78 pips would have been the average trade, meaning that with that type of information, now you're going to think, okay, so then my maximum stop loss or my maximum pips per trade, you can then take it up to maybe, let's say, at 100. So 100 pips would be, let's say, your maximum allowable risk for that. So it gives you that type of information, meaning that within the tested period, it would have given us, we would have actually gotten 89.18% in terms of a gain, all right, within that period. So we were close to actually doubling the account. Okay, and again, pay notes. In this particular test, we were just testing in terms of the strategy. I was not actually factoring as well money management, which is another section in terms of how then when we are reaching or generating profits, how then can we maximize that in terms of using what I coin or what I was taught, the delta. It's called the delta method. Basically, in its basic sense, what the delta method is the ability for you to increase your position sizing based in terms of how much profit you are gaining over time. And it works the opposite way around as well. As you are losing your positions, how then can you decrease your position sizing for you to be safe in terms of you not blowing your trading account? So again, these stats were actually interesting as well, because you can see in January we would have taken our win rate to 60%, and in January, February 50, 80. So we in essence didn't have a losing month basically in this particular strategy that I was actually testing within the tested period of 2017. And it's actually gives us interesting information as well. Average winning trades, okay, it gives us the dollar figures, and the average losing trade as well in terms of dollars. Our total P&L, average risk per trade. So the highest one, means that as we're taking positions on, the biggest one, the biggest risk we took on this particular strategy was, I believe, 2.5. 2.8, they're 2.8%, meaning that on average, risking about 3% of the account, we still would have been safe. Okay, and again, this type of these trades, I was looking at it for the total period. So I started in January, okay, 2017, all the way down to December, I believe. Yeah, so it's pretty much the whole year of 2017. I was looking at it in terms of strategy, and what was interesting as well, it was a favorable strategy. Now let's actually look at some of the interesting things as well here. Let's look at the streak. Now I want to look at the winning streak, okay, of the strategy, and the losing streak of the strategy, because this is important. So you would see that on average, the maximum winning streak on this strategy, you can see it actually happened up here. So in the beginning of the year, the strategy was actually performing pretty good, a pretty, let me see. Okay, January. Okay. Okay. So if you're looking at a winning streak, okay, we had three winners here, two losers, two losers. Okay, and then we had 2, 4, 5 winners, 2, 4, 4 losers. So on average, it's about. Oh, and then there's another huge losing streak. 1, 2, 3, 4. 1, 2, 3, 4, 5 losing trades in a row. How many winners? Okay. On average, you're looking at about four wins, 5 losses, which gives you again back to that whole 57%, or just a midpoint, in terms of the winning rate of the strategy. It's about a 50. It's about yeah, it's a 57% basically, and that 57% in me winning, even though you're winning 57% of the trades, it means those winners over time gave me a return of about 89, almost a 90% return. So I almost doubled the account, okay, within the period of 2017. Am I happy with this result? Yes, I am. Initially, as this is just rough in terms of looking at it from a perspective of, we could tweak this more and make it perform better, maybe even doubling, or yeah, doubling or even tripling the account when we go into position sizing. And let's see if I can maybe show you this, guys, in terms of position sizing. Where is it? Because I want to see if I can actually share this with you. Okay. Okay, never mind. Okay, I'll probably do it later. Maybe do a follow-up video on this, and then showcase to you that. Alright, let me just get back onto the screen. Okay, so I'm back. Now, just looking at that one, you would have seen that, okay, it's important when you're doing your backtesting, okay, to look from left to right. Because again, what we want to do is we want to be as objective as possible when we are doing our backtesting. Our goal at the end of the day is we want to find out whether or not our particular strategy is profitable over time. Because at the end of the day, we're going to now put money, our actual capital, and actually trade that in the live market. And then the next thing when it comes to backtesting as well is consistency. When you are doing your backtesting, it's important to actually set up a time. Maybe they say 2 hours or 3 hours in a day, and then you're going to focus in terms of backtesting. Because again, what we want to do is once we found our results, you're now going to be doing the very same thing in a live account where you are now actually trading. And the fifth thing is you are training your reticular activating system, or you're basically training your mind to identify that particular strategy in markets, example at times when the markets are in chaotic conditions. So as a professional trader, it allows you now to actually amplify your technical skills and identify those strategies in times of chaos or even in times of calm when the markets are actually calm. So yeah, so pretty much that's what I wanted to actually share with you guys, and I hope this I won't say review because we're not actually looking at trades in terms of the week, but this training actually helped you guys to really identify the importance when it comes to backtesting, the importance of actually looking at data, and the things that you actually find as well. You know, we've looked at really the average win rate, okay, of the strategy. We found out that the strategy over time gave us almost a 90% return. Okay, that particular strategy was actually looking at, or that I was actually testing. So if you feel as though this type of information is something you would actually look forward to actually learning, feel free to actually go below, okay, on the description of this video. Okay, go through the free course, and if you want to get in touch with me and learn the proper methods of actually trading, or the methods of you getting from really not making money, or if you're starting out to actually making consistent profits within the markets, please feel free to actually contact me, because I really have a lot of value to actually offer to you guys, in the form of really training material in the markets. Because a lot of the time is a lot of people focus on the wrong thing, and that is actually focusing on trading and making it a get rich quick scheme, which again, it isn't. It's really about consistency. Consistent execution gives you consistent results. So without further ado, guys, please trade your plan your trade, take care, and cheers.